Most of us have this idea baked into our heads that to get seriously wealthy, you need a massive salary, right? Or maybe you get a lucky break, pick that 1 in a million stock. But what if all of that is just wrong? What if building wealth has nothing to do with luck at all? The material we're diving into today says it's not a game of chance. It's a game of physics. All right, to really get this, we're going to start with a bit of a paradox. It's a story about two people heading down two totally different financial roads. Let's call it a tale of two earners. Okay, so on one side, you've got your high earner. This person is pulling in a cool $250,000 a year. A huge income. But here's the catch. As fast as that money comes in, it's flying right back out. We're talking the newest car, the latest trends, that whole high-status lifestyle. And then, on the other side, you've got the modest investor. They're making just $60,000 a year, but they live, well, differently. They're investing the gap between what they make and what they spend. So here it is, the big question. Who do you think actually builds the bigger legacy in the long run? I mean, your gut probably says the person with a massive income, right? Of course. But the real answer, well, it's not what you'd expect at all. And here's why. The answer isn't buried in some complicated economic textbook or shouted on the financial news. Nope. It's found in a fundamental law of the universe. We are about to uncover the hidden physics of creating real, lasting wealth. This is the core idea, and it reframes everything. It's not about being smarter or luckier or having some inside track. It's about understanding a force that's just as predictable as gravity. So what is that force? It's time. That's it. So simple, right? It's the single most powerful and honestly the most overlooked ingredient in the entire wealth equation. See, our modest investor gets something that the high earner just doesn't see. Let's call it the axiom of wealth. And it goes like this. Money isn't this loud, flashy thing. It's a tool. And it does its best work quietly in the background over really long stretches of time. It's fueled by patience and discipline, and it has almost nothing to do with how big your paycheck is. Okay, so how does this actually work? Like, what's the mechanism? This isn't some kind of magic truck. It's pure math. And there's this simple, beautiful engine that drives the whole thing. It's the math of doubling. And there's this awesome little mental shortcut you can use called the rule of 72. It's super simple. If you want to estimate how long it'll take for an investment to double, you just divide 72 by the annual interest rate. That's it. So for example, if you're getting a 7% return, your money is going to double in about 10 years. Now let's actually watch this play out. Let's say you start with 10 grand. After 10 years at 7%, you've got 20,000. Pretty good. After 20 years, it's 40,000. Okay, things are moving. But now, watch what happens next. At year 30, you're at 80,000. And by year 40, that initial 10 grand has turned into $160,000. The growth just starts to go parabolic. And this chart just nails the point home. In that first decade, your money grew by $10,000. But in the fourth decade, it grew by $80,000. All the real, life-altering growth happens at the end. Time is the one doing all the heavy lifting for you. So here's the biggest takeaway, the thing you absolutely have to remember. The greatest financial mistake you can make isn't picking the wrong stock. It's interrupting this process. It's getting impatient and cashing out too soon, stopping this incredible compounding machine right before it really gets going. Okay, so we've seen the power of time. Now let's talk about its arch nemesis, the hidden trap of modern spending. This is where our high earner goes so wrong. Just think about $1,000. What could that be? A weekend trip, maybe a new phone, a fancy bag. It feels like a simple one-time purchase, doesn't it? But it's not. Once you get the physics of time, you realize you're not just spending $1,000 today, you are actually spending the $10,000 that it was on its way to becoming. You are literally setting fire to your future wealth. These are what we call depreciating assets, and they are absolute wealth killers. Think about it. A new car that loses a chunk of its value the second you drive it off the lot. Designer bags, the latest trends that'll be out of style in 6 months. This is the black hole where the high earner's massive salary disappears into stuff that actively fights against their future. And this brings us to the final piece of the puzzle. And honestly, it's the most important one. If building wealth isn't about buying more stuff, then what's the point? The real goal is to buy the one thing, the ultimate asset that truly matters. I really want you to let this one sink in. Wealthy people don't buy things. They buy time. They're not using their money to pile up more possessions. They're using it to buy back control of their own lives. They're buying freedom.
You see, every single dollar that our modest investor saves is actually a trade. They are trading a small, fleeting pleasure today for the ultimate prize tomorrow, freedom. The freedom to choose their own work, to control their own schedule, to literally own their time. That is the real return on investment.
So when you boil it all down, the path is actually incredibly simple. You don't need a fancy finance degree, you don't need a secret stock picking algorithm. All it takes is patience, to just let time do its thing, a focus on the fundamentals we just talked about, and, well, a little bit of trust in the math.
And that leaves us with one crucial question to ask ourselves. The next time you're about to buy something, stop and think. Are you just spending dollars, or are you spending your future decades? The answer to that question, well, it could change everything.